Hey guys, Dave Keller here with Market Misbehavior. I'm often asked about a technical indicator, or really a breadth indicator called the Hindenburg Omen. Particularly in the financial media, they love to ask about this particular indicator because it has sort of a foreboding name. But it is an interesting measure of market conditions that are very similar to previous market tops. So today, what is the Hindenburg Omen? So the Hindenburg Omen is obviously named after the Hindenburg, the dirigible that went down in a fiery explosion. And the name Hindenburg Omen probably gives the appropriate sense of what this indicator is designed to do. It basically only triggers when there's a market that's been particularly strong and then starts to show similar conditions to previous market tops. Now, the challenge with the Hindenburg Omen is not 100% as with any technical indicator. I wish there were technical indicators that were 100% effective and accurate, because those would certainly be the ones I use. But in general, they tend to point you in the right direction. What we're going to do today is look at what the Hindenburg Omen actually is. It has three components, and I'll share with you what those are and why they're important. Then we'll look at some brief market history and see when the Hindenburg Omen has been triggered, because in the last couple months, we've seen a cluster of Hindenburg Omen signals, which is fairly negative for stocks. Before we get to the charts, though, as a reminder, if any sort of thinking like this about investor decision-making, behavioral finance, and technical analysis is of interest to you, I hope you'll subscribe to my channel. It'd be great to have you along this ride. Also, give the video a like if you appreciate it. We'd very much appreciate that back. Finally, put a comment below the video. Do you think the Hindenburg Omen is accurate here? Do you see the bearish sentiment? Do you feel that there is potential downside for the S&P? And if so, what's your downside target? Let me know in the comments below. Let's get to the charts. All right, so here we're looking at a chart of the S&P 500. We're going back for the last 5 years. And the bottom is an indicator that we have on StockCharts, which basically tracks the three components of the Hindenburg Omen. What I'm going to do is just show you quickly where the Hindenburg Omen has been triggered historically. Then I'll show you the three components and what actually comprises this. The Hindenburg Omen basically is looking for conditions of market strength. The market has to be in an uptrend overall leading up to the signal. Then you basically look for an expansion in both new highs and new lows, which shows market indecision, where stocks are both going higher and going lower around the same time. Then you actually get breadth conditions turning negative, and you have to have a cluster of signals. So it's not enough to just have one signal like we did randomly in August of 2021. You need a cluster over a 30-day period or so to indicate that there are repeated indications of this market indecision. And if you look back just simply at the purple shaded areas, ignore the recent one right now, and just look back to where we were at in February, March of 2020. We had the market going higher, and you see this cluster of signals. July, August of 2019, which wasn't a huge drawdown, but certainly not an insignificant one. September of 2018, before the sell-off into the December lows at the end of the year. January, February of 2018, which is the beginning of a 6-month consolidation before you made the blow-off high, and then one failed signal there in November of 2017, where the market dropped just a bit during that period, but really ignored it and kept on going higher. One of the critiques of the Hindenburg Omen, I was told it called 10 of the last 3 corrections. And what that means is you'll get some false positives, right? You'll get this indicator triggered. It doesn't always, lead to a significant drawdown. But if you look, January 2018, pretty steep drawdown. September 2018, pretty big pullback. February, March 2020, obviously a significant January, February certainly is when this was triggered, a significant drawdown. So it happens at many major tops. And as a matter of fact, there are very few major market tops that don't have these conditions related to them. Now, where did the indicator come from? We'll look at another chart here, which breaks down the three components. There was an analyst named Jim Miekka, I think in the 1990s, who created this methodology, and basically has 3 components. And I should warn you, I'm giving you the 3 components that I sort of use and I'm familiar with. I will tell you there's some debate and discussion about what the exact components are, and so I'll show you the ones that I'm using and some of the options that other people pay attention to. But there's really 3 components to it, and I've broken down the chart of the S&P and then the 3 individual components panel by panel. So the next one down is looking at new highs and new lows on the New York Stock Exchange. So you need to have over 2.8% of the total New York Stock Exchange listings making new highs, and at least 2.8% making new lows. So basically you have a significant or a non-zero number of stocks making new highs and also a non-zero number of stocks making new lows. This is an interesting one because I sort of thought you'd be looking for a bunch of new lows in a market top, and that would be sort of a divergence. And that is an interesting divergence to look at. But the idea here that Jim had created was basically looking for indecision. So you need stocks making new highs and also stocks making new lows, which shows you that the market is sort of bifurcated. There's a lot of indecision, a lot of conflicting evidence, because that usually happens at the end of a bull market phase, or at least his theory goes. The second piece is looking at the overall trend in the market. You need a stock market in a significant uptrend. There are a couple different ways to do this, but most of them revolve around the New York Composite Index, which on StockCharts is $NYA. It may be an index you don't look at as much, but it's basically an index that tracks the composite, all the listings on the New York Stock Exchange. So it's a pretty broad universe, broader than the S&P or one of the other major indexes that you might have followed. Now, the couple ways to do this, I've had people talk about the Dow needs to be above its 10-week moving average or its 50-day moving average. The New York Composite needs to be above its 10-week moving average or 50-day moving average. The moving average needs to be sloping positive, those sorts of things. What I actually use is the 50-day rate of change needs to be above zero, which basically means over the last 50 trading days, we need to be higher than we were 50 days ago or 10 weeks ago. I think that's sort of the essence of what Jim Miekka was trying to come up with. However, again, there's some debate among my industry peers about which of those is the right answer. I tend to think a lot less of that. I think the essence of it is looking for a market in an uptrend. As long as you have some way of measuring that, I think you're in good shape. So in this case, the let's see, the gray line is the New York Stock Exchange. The black line is the rate of change. And as long as that is above zero, it might be hard to see, but it's just above the zero line. You can see it's net positive right now. That's enough. And you just need to be higher than it was 50 days ago or 10 weeks ago. Finally, the McClellan oscillator needs to dip below zero. This is a technical indicator that fluctuates around the zero level. Tom McClellan, many of you may know, and Tom's parents and Sherman McClellan, his father, is one that many have known. I've enjoyed getting to know over the years. They created this McClellan oscillator. It's just a measure, basically takes the advanced decline line and then smooths that out. So it's basically looking at market breadth. And when the McClellan oscillator gets below zero, that means the short-term breadth is going lower than the long-term breadth, and it indicates short-term weakness in the market. So combining these three together, we have a market in an uptrend. We have both new highs and new lows, and then we have the McClellan oscillator dipping below zero. Now on StockCharts, we have an indicator, BINYHOD. And what that basically does is it tracks the three components. If all three of them are not signaling, the indicator's at zero. If all three of them are signaling thumbs up for the Hindenburg Omen, or indicating a positive signal for the Hindenburg Omen, it goes to +3. So all you need to do is put this indicator on your chart and look for when they get to +3. Now, one important component is it's not enough to just get one signal and then that's it. You actually need a cluster of signals, a couple signals within a 30-day period, which indicates a repetitive sense of that conflicted market, right? And so I've highlighted with the purple shading now. There's the same highlights we had on the previous chart, but now you can see all the indicators lined up together and how it relates to the bottom. And now you can see how this most recent upswing, you actually have this cluster of signals. Now we had two of them within 30 days in December. We now, again, 30 days later, have another set of signals in the last week. So overall, this is really indicating the Hindenburg Omen signal. So what is this basically telling you? What it's telling you is similar to these other signals. The conditions right now are similar to where they were at previous major market tops, meaning a strong uptrend up until today, which has certainly been the case, an expansion in new highs and new lows, which we're starting to see because there are enough new lows that are being registered. And the McClellan oscillator has dipped below zero just briefly in recent weeks, but certainly spent a lot of time in November and December below the zero line. So that combination is similar to what previous market tops have looked like. Now, again, this is no guarantee that the market's going to go down from here. It doesn't say that it's necessarily calling for a market top, although people love to make that assumption. All it's telling you is that there are similar conditions. So how do you actually use this? What it tells me when the Hindenburg Omen is signaled is to start to think more defensively, to start to look for signs of the market breaking down. This is sort of the early warning signal, early warning system indicating that there may be conditions of a market distribution. Now you have to pay special attention to key support levels and determine when the market is actually following through on that bearish configuration. And that should allow you to differentiate something like the October-November 2017 signal, which never really materialized because support was never really broken, versus many of these other signals where soon afterwards we broke key support levels, moving averages rotated lower, and you saw a much weaker breadth across the board. It indicated that the conditions were getting less and less bullish and more on the bearish side. So that is the Hindenburg Omen, again, an indicator created by Jim Miekka a number of years ago, and really has always been a fascinating name for an indicator. And I know in financial media we love to highlight when the Hindenburg Omen is triggered. What I've shown you today is it's not 100% accurate. I wish there were indicators that were, although probably they'd stop being accurate if we all followed them. But this is one that gives a series of false positives. However, what you are looking at right now in the last 6 to 8 weeks are similar conditions to previous major market tops. And for me, that's enough to start paying attention to key levels. So for example, S&P 4550, I think is a really important line in the sand to be watching now in the financial markets. As long as we hold that, conditions are okay. But if we get the Hindenburg Omen and then we break 4550, we start to see further breadth deterioration. That could tell you about a heightened risk for further downside for stocks. So what do you think about the Hindenburg Omen? If you like this sort of thinking about investor decision-making, market history, technical analysis, breadth indicators, sentiment, all of the above, hope you'll subscribe to my channel. It'd be awesome to have you along this ride. Also, give the video a like if you liked it. We'd very much appreciate that back. Finally, put a comment below. What do you think is the most important level on the S&P 500? I think 4550 is a key one. What do you think? Let me know in the comments below. From everyone at Market Misbehavior, I'm Dave Keller. Stay safe. Talk to you again soon.